Welcome to our class today on protecting your red money. Author Dave Vick and advisor who wrote the book Bat Stocks Vegas and Conservative Investing speaks to this issue of market and investment risk. Specifically, he came up with a color code for investments that to help us identify the kind of market risk that we're subject to, and the color red was as a color that he gave to this investment in the stock and bond market asset category. So, for example, assets that have the opportunity to gain in value, give us the most in terms of return, also provide or expose investors to a higher level of risk. So protecting your red money is the topic of today's workshop, where we're going to look at strategies and ideas on how to reduce the risk of those kinds of investments you might be making. My name is Warren Wall. I'm a certified financial planner. I am also a money manager with my own company, Wall & Company, and our specialty is that we have and provide proprietary investment strategies to help our clients make better decisions about when to be invested in these higher risk asset classes called stocks and bonds and when not to be invested. We have had, over our history of time, we've been doing this over almost 20 years, and we've been blessed with some high ratings by a variety of money manager review newsletters. And so what we do and have done in the past, we hope and believe will continue to be successful moving forward. So today's course is to find out or share with you about ideas of how to make better decisions with your stock and bond market investing. So let's move into that. This is a chart that you've seen me talk about already, and that is the chart about the stock market. This is, if you will, I call this the red money proxy. It's the market. The market going up, the market going down, the risk of the market. So one way that we talk about risk and the history of market risk is we look at what we call bear markets. Bear markets that are markets that have dropped more than what? 20%. And we have a history of markets. And as a matter of fact, I think in your handouts you have some sort of and it may be you don't. It's on my website, so if it's not in here, I don't see it. But, well, we're going to refer to this in a moment. This is a brochure piece that's actually on my website, but I wanted you to see the history of the bear markets just to understand that going back to the Depression, you see 1929 to the period of June of 32. The market dropped for 33 months, and it lost how much?
86.7.
86.7%. That was called the what? That was called a fiasco, the crash. It was the Depression. It's when the markets collapsed. My grandfather, you remember, this was his generation, growing up in the shadows. Would you be interested in buying stocks if you saw this experience of a decline? And most would not. And as a matter of fact, it took over 25.2 years for the money to come back to break even. Now that was the worst story I could share with you about bear markets. Other bear markets, as we go through and look at them, we can look at the most recent ones. The last one we did was 2009. It was 18 months. The market did drop almost 48%, right? Yep. It took how many years to break even? 5.5. Break even means it dropped, and it took 5.5 to get back to even. The September of 2000 to 2003 dropped 30 months. It took 6.8 years. Everybody's with me. You understand there's risk. Question is, what do we do to manage that risk? So there's two approaches, and this is two broad approaches. First is we could pick from one of two styles here, tactical management or buy and hold investing. So let's look at this thing called tactical. As a matter of fact, before we do, let's actually make sure we understand what buy and hold is. I can buy a stock and just hold that stock forever, or as long as I can. And if I had bought and held the market forever, and that's kind of referring to this chart we saw before. I just ride all of the market's ups and downs. That's what buy and hold is. Tactical says, well, maybe there's a time when markets get up there and start turning. I might want to get out. That's called tactical. The word tactical comes from tacting, which is really a sailor's term. You know, the tacting in the wind changes and my sail changes with the wind. If you think about portfolios being a sail, my portfolio might change sometimes too when the winds of change of the market come upon us. And so tactical investing is really making active management decisions about when to be in and out of the markets. Okay? All right, and using the sailor analogy, if there's a storm at sea, what do you do with your sail?
You take it down.
You take it down. If you don't take down the sail, what happens to the boat? It will flip over. You could drown. So I think of the market being the stock market, the winds of change, the winds of decline. Boy, I do not want to be in the market when the winds are high. I want to be out. Rather be in safe harbor, wouldn't I? I'd rather not be in there at all. Certainly don't want the wind, the sails to hit my wind, or the wind hit my sails open and flip me. So this is a very primitive way to describe it to you, but if you follow the buy and hold concept, do you see the jagged lines going up? And
Yeah, those are the waves.
those are the waves. Thank you. Good analogy. We buy and hold and we're happy, 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 happy. It's going up, but then what happens? Poosh. Well, it goes down, and we've talked about this emotional roller coaster, right? Well, tactical simply is a conceptual thing or process that says when markets decline, when they head south, just get out, go to the safety zone, be out of harm's way. When markets are rallying or moving up, get in. When markets are down again, move to safety. Safety is generally in tactical management cash or short-term bonds. It's a place where your assets will not lose when markets are going down. So if you did this the right way and you are out of the market through most of the decline and in the market through most of the rally, what you should have on the tail end is an asset that's greater in value than just simply buying and holding. I mean, that's the whole premise, if you will, of tactical investment management, is to hopefully have more dollars left over in the end with less risk, less volatility than buying and holding. So let's look at that more closely. The three decisions as an investor you have to make. One is if you're a buyer, when to buy, what should you buy, when should you buy or sell, and how much should you buy or sell? Would you agree? I mean, those three questions are the key to making any kind of a decision in the markets. So I want to play the game with you, and you all got a copy of this. So let's go ahead and open up your folders. And what does this remind you of?
The periodic table.
Absolutely. So this is the periodic table of investment returns. And the way to read this chart is from high to low each year, you see what was the best performing asset category, its return relative that year to the returns of other asset categories. There are 9 asset categories that are color-coded here. 7 of the 9 represent equities, stocks. 1 represents bonds. 1 represents CDs. So if you will, the universe of the 9 that's listed each year represent about 80+% of what you could even do with your money as an investor in the marketplace in just those 9 categories. So far, so good. So everybody understands the chart. Each year I can see here's small cap value was at 14.03% in 01, but down here MSCI EFA, which is the international index, international investing, lost money that year, minus 21%. And I could see from high to low what it's doing. So let's play the game. The game is my grandfather. You remember my grandfather hated risk, right? He did not want to have a penny invested. So what he did, and actually, what he did is and he would have done, would have put every dollar he had in a guaranteed investment. So in this selection of these choices, that guaranteed investment would have been CDs, right? If I took CDs and just rolled them, and I'm not looking at taxes, that guarantee over this period of time, which is, almost 15 years, 100,000 grew to 134. Taxes are not withheld in this example. And over here you see the year 08. I want it just as a sideline to show you how that investment idea worked in the down year of 08 as as a measure of risk. CDs in the year 08, you'll see we're making 3.14%. All right, most people are advised, and for whatever reasons, that you take your money and spread it out across all of these asset classes. We call that asset diversification. So, and I say for whatever reason, meaning that it's the old theory, Markowitz theory, that suggested, and he was an economist who designed a theorem around asset allocation that suggested you just ought to put your money equally or somewhat equally in all asset classes and buy and hold through all ups and downs of the market. So let's play that game. Let's say we did that. We call that invest equally, buy and hold, and sure enough, it outperformed the CD. That 100,000 over that period grew to 224,000. But we did have some downside risk, and that buying and holding and diversifying our money in the year 2008. If you look at 2008, all the different returns mostly negative. In other words, being diversified really did not buy us a lot of protection, did it? As a matter of fact, the average balance fund, a Vanguard balance fund, modest growth fund, that's 50-50, 60-40 stocks and bonds, what happened was it didn't buy us protection. Why? Why would you think? Well, isn't diversity supposed to buy us safety? And I asked the question why. I propose that the reason for that is something that is material to what's changing in the marketplace, and that is correlation. The theory behind this great man, Markowitz, was if I diversified by having money invested in different segments of the market or internationally, that when our market's down, this market could be up and it would wash the two. Isn't that the idea of diversity? But what has happened to our markets over recent years? They've become more correlated. Correlated means they're almost acting in unison. So when the U.S. market is down, what's happening overseas? It's down. If markets overseas are down, what tends to happen in our market? They go down. There seems to be this correlation happening. So this idea of buying safety by diversifying with different stock asset classes is really not working the way it should. And that's what explains why even after all that diversity, we just didn't get the safety that we should have gotten or would have expected to get. Okay? So let's look at some other ideas. I'm going to talk in generalities, but let's play the game, something you've been taught never to do, on investing, I should say, and that is buy the winners. Look at last year and simply buy last year's winner. And I'm going to be specific here. Buy last year's equity winner. Okay, so that's the way we look at this. January of 2002, I look back and what was the winner in 01? Small cap. So that year, the beginning of 02, I bought small cap value and held it for the whole year. That actually wasn't a great decision, was it? No. Okay, but that's what I did. Year end number 2, January of 03, I'll look back at the number 1 performing equity leader. This is a bank CD and a bond above it. I don't buy those in this strategy I'm talking about. I'm simply buying last year's equity leader. So I bought mid-cap at the beginning of 03. I bought the prior year equity leader, which was the one that didn't lose as much. But I did that each and every year. And if I did that each and every year, I want to show you the outcome of that simple strategy. And it actually outperformed all of them so far, right? You see that buying last year's winner actually worked. But now what didn't work is what?
Oh, wait.
Whoa! Oh wait, it was painful. You bought a liter the prior year that just got tanked when the markets went down. And so buying equity leadership actually does produce and did produce more growth, but it came at a price. It came at a price of higher volatility or higher risk. Now, let's take this step a little further. So if we recognize that 08 came along and the markets went down, what strategy or what tool might I have used to help minimize market risk? One tool is called a moving average. A moving average, and I'll show an example of this using the S&P 500. This is the S&P 500 month-end closes. You see the dots here? This goes back to 95, and it's simply illustrating what the S&P index closed at that end of that month. And I'm looking at the 12-month moving average. That's this little blue line that is trailing those closing prices of the S&P. It's simply math. It's looking back 12 periods of time and averaging out those 12 prices. That's what a moving average does. This is a very simple strategy that I'll share with you, in that what you're doing is only owning stock investments, only when the month-end price of the S&P is above its 12-month moving average. Those are the green dots. The green dots means the price closed above its moving average, 12-month moving average. That would be one tool we could use that says it's in an uptrend. If ever it's above its moving average, the market is in an uptrend. If it drops below its moving average, what color is it? It's red. And if it was red, we wouldn't want to be in the market. We'd want to be out of the market. So now, you never know. This is looking at history. You don't never know if it's the right decision or not. But using this example, what we're seeing is that using this tool, we gained most of the market gain. We missed most of the market loss. Gained most of the gain. Missed most of the loss, and gained most of the recent market gains that we've experienced since 2009. Now, nothing magical about this tool other than the fact that it worked, right? As I show you this example, how many of you got out of the market December of last year before the crash or before the correction? Well, we have one lucky soul. Huh? Okay. Well, our clients completely got out. Not specific because of this tool, but something similar that we use as an indicator. Now, that doesn't mean we're going to always be right. It just means that this time we were, and if this market continues to unfold into a bear market decline, it could look something like this, couldn't it? I mean, isn't that the risk? Yeah. Okay. Or it could look something like this. It could have just faked us out for a few months and then bounced right back. But if it did, you would just get right back in, right? So
you stay above the fray.
What's that?
You're above the red all the way, right?
Yeah, we're in the market here. We're out of the market here.
Gains, like
that's right. We're making gains, or investors are making gains as you're in the market through this. You're out of the market. You're protecting capital when markets decline, and you're back in when markets rally. This, again, is a tool. I just want to share with you a simple idea. What if you applied that tool to buying last year's winner? Buy last year's winner, and each month map that winner according to this tool. And this is what before I go there, this is also just a historical average of the S&P using the 12-month moving average technique I just showed you. This is showing you going back to 1994. If you had taken the 12-month moving average tool that I'm talking about and applied it to the market, your money would have grown, that 100,000 would have grown to over 700,000 versus buy and hold at 444. And you would have not experienced all these big ugly declines. Pretty powerful story. But anyways, let's apply that concept to buying last year's winner and each month looking at that overall market decision of whether to own it or not. And what happened is the money grew even larger than what we had the prior leadership strategy. And what was even more and equally fascinating is that the risk of our market decline went way down, didn't it? I mean, it still went down a little, went down 10.75, but that was a more manageable decline. Okay? Now, at Wall & Company, this is just to give you a quick plug. I will tell you that we use a little bit different strategies when I'm showing you, but I want to just give you a little quick overview that you don't want to do this on your own is my view. I mean, even as simple as it may sound to do this on a monthly basis on your own, what did I tell you the temptation was with emotional roller coaster? Our temptation is to let other influences get us off track of things we should be doing. I would suggest, it's kind of like weight loss, up at the Weight Watchers and other kinds of fun things. What I have found that works for me, and I think works for most people if they're really sincerely interested in losing weight, is you hire a coach. You go to a program where somebody's supporting you in that effort, right? We all know it's eating less calories to lose weight, right? We all know there are things we can do, but we don't do them because I don't know what it is. It's human nature, we're wired that way. So when it comes to investment decisions that you know may work for you, sometimes having a third party help you stay in the game, stay dedicated to the process is, I think, extremely important. Of course, that's a little bit of a personal plug, whether it's me or someone like us, is to find a process and approach that works for you, that you know works historically, and apply that process over and over, hopefully with the help of others that can help you through that. Now, with that said, there's a little bit of a handout. I think, this is our process in terms of equity management, but just to let you know, we look at the full market, all the different asset categories, much like we're showing you here. And from that, we choose, we monitor what the top performer is in that universe. We then apply that trend analysis, and our trend analysis is different than the 12-month average because there's some things that we think work better than that. We apply that and we decide what leader to buy and whether we should be in it or out of it, being either in cash or short-term bonds or being invested. And we repeat that process not once every year, but every 30 days. In other words, markets change, leadership changes. So we want to be in tune with what those changes are. So applying our approach to that leadership calendar, ours outperformed relative to the others that we're showing, and it did it with far less volatility than what we're showing. The point of it is I'm just trying to share with you that there are processes you can follow that help you minimize risk. This is extremely important as it relates to retirement, and I did pick on, these are some fake names, but I took some real life scenarios. We may know people like this in our lives, but Connie Conservative, Peter Hope, and Sammy Savvy. Connie, and this is an example of taking these ideas I'm just now sharing with you. This is Connie, and Connie did not want to take risks. My grandfather. She had $300,000. She wanted no risk. She took the CD route. You remember the CD route? Gives us no risk. She rolled it each and every year, and she took out from her $300,000, $21,000 a year for her needs, but she inflated it each year at 3% per year. She put it into the CD markets, and so what we could see with Connie, her monies have gone to zero as of last year. This is the worst nightmare, if you will, of seeing an asset go to zero. In this case, it did.
Didn't take long.
Well, it actually took some years, 2000. Yeah, we lasted for about 15 years till it depleted out, but it was gone after 15. Now, Peter Hope had heard from his advisors the best thing you could hope to do is diversify. Spread your money out, take money off each year, but just stay diversified. And he followed that buy and hold allocation model. And his has now dropped, the $300,000 after his withdrawals have dropped to under $67,000. Now, he's not destitute, but certainly concerned. Sooner or later that money's going away, maybe by next year or the year after. Sammy Savvy heard with delight how he could have used technical analysis to help minimize risk, and used this concept of moving the money out of harm's way when the markets are going down and pulling money off of his account like everyone else did, taking the $21,000 inflated, but stepping out, moving away from market risk when the indicators said to get out of the markets. And in this case, we're seeing that Sammy's money certainly did grow. It doesn't mean it went in a straight line up, but he's taken out his income and he still has dollars still left over and beyond what he started with, even after all these years, and that we call that being confident. And in terms of planning, we think that's extremely, it's how do you feel about your assets and management, and it's when we get not confident that we make bad decisions with our planning. So this is just a chart line again to express the differences between those three investors, but here's some points, and also I need to disclose to you, this is hypothetical. These illustrations are showing hypothetical illustrations of what-if scenarios. But here's some of the things that I do want to talk to you about. Connie conservative, playing it safe, was actually the highest risk strategy of all. Everybody follow that? Being overly cautious, overly, not investing money for a return was the wrong, I mean, she thought it was enough return, but in the end it wasn't. Why? What happened each and every year? She didn't lose. She just didn't keep up. She lost opportunity, didn't keep up with inflation, right? Inflation kept going up and her money wouldn't keep up with inflation. So this is the concept, that one of the major points I want to share with you. Buy and hold is simply a stock strategy that guarantees you that you will always be in the market when it drops. Now, it guarantees you'll always be there when it goes up, but it guarantees you'll always be there when it drops. That may not be overly concerning to you while you have time to accumulate assets, but when it comes to time to draw down assets for income, it should concern you. It can have dramatic impact. Tactical leader is, again, just expressing to you that there's an opportunity of using techniques and technology that help minimizes the risk of drawdown to prevent losing all you have potentially with your investments. So this brings me to some closing thoughts, and here they are. As a CFP, I think there are 5 reasons why people fail to accomplish what they can in their retirement. Number 1 is emotions, and I say that, and I've already touched on that, but I will summarize it, that making the wrong decisions based on a gut feel, an emotional feeling, you've got to find a way to minimize that feedback loop, doing the wrong things from an emotional view. The other is overpaying taxes, not being intelligent about how you should minimize taxes when you start withdrawing monies, in terms of how you accumulate your money, certainly has an impact. The other is ignoring inflation. That means making plans for future needs without accounting for the rate of increases that are going to happen with inflation. 4, it's having no plan, and specific to retirement, having no financial retirement plan that helps you understand where you are today, where you want to be in the future, and whether or not your assets will last over that period of time. Everybody know what the worst one is?
Doing nothing.
Doing nothing. What's another word for that? Procrastination. And so, some of you have heard me tell you this before. It is the truth. It is the truth. And it means that you have knowledge and information that can help you do better, but you don't use that knowledge to improve your lives and your situations for the better. And so with that, I'll kind of pick on this man here to talk about what that definition of insanity is. Exactly. Doing the same thing over and over, expecting a different outcome, and so ultimately you are now all overly educated after sitting in front of me for a few hours today, understanding all the things that you need to understand. So with that, I want to congratulate you for making this commitment to learn and to get educated. I want to also, I know most of you probably have already signed up, I look forward to meeting with you to have this discussion in more depth and detail with you individually about what it is your needs are and how we might help you.